Hi there, this is Mr. Evans. This video is going to introduce the economic environment. So as part of our PESTLE analysis, our analysis of the external environment, one thing that we're going to really want to make sure that we understand what's going on in is the economic environment. Really fascinating area that has a massive impact on businesses. These are the economic factors that you need to have a good understanding of, and I'll go through and produce a video on each of these. But first of all, this video is just going to give a bit of background to what we're talking about the economic environment. Now, just as an aside, it's really important that you keep an eye on what's going on in the economic environment in the UK. It's an area that's changing all the time. And if you're able to use examples in your answers at AS and A2, I mean, this is an A2 unit, but if you're able to use examples of what's going on in the economic environment and the impact it has on the opportunities and threats for businesses, you're going to be looking at information there that the examiner is going to really like and will put you towards the top of the grades if you can use that information properly. So, the economic environment considers the impact of economic factors on the consumption and production behaviour of individuals, firms and governments, as well as economic agents abroad. Okay, so that's quite a long definition. So first of all, I've done something that I really don't like in the definition, which is I've defined a term by using the same term. In other words, I'm trying to define what the economic environment is by explaining that it's economic factors. Now, I've searched for synonyms and I really can't find an appropriate one for economic factors. What I mean by economic factors I'll go into in just a minute. It's economic growth, employment, balance of payments, interest rates. There's all sorts of economic factors, but the point is that these economic factors have an impact on the consumption behaviour, that's what people are buying, and the production behaviour, that's what's being produced in an economy by businesses, of individuals, that's households, yourself, your parents, me, we're all individuals within the economy, firms or businesses, and governments, as well as economic agents abroad. Okay, so this is a huge definition. It encompasses a lot. So let's see if we can break down a little bit more about what the economy actually is. So this is a very simple diagram that shows the economy. Okay, so on a very basic level, we've got businesses and we've got households, we've got individuals and we've got companies. Okay, and this arrow here, every arrow represents a movement of money. Now, when households buy products off businesses, they are consuming. It might be a product, it might be a good, it might be a service, but households give money to businesses in exchange for goods and services, which is called consumption. Now, in return, businesses give money to households. Well, how do businesses give money to households? They pay them factor payments. They pay them rent if they're borrowing, if they're using buildings. They pay them wages in exchange for the labour that households provide. In other words, people go and work for businesses. And if households have shares in businesses, businesses pay their shareholders a share of the dividend. So we've got a circular flow here of money coming from households to businesses and businesses returning money to households. Now, the more money that we've got circulating in this, the more consumption that's going on and the more money that's coming back to households, generally we consider that a good thing. There's some debate about whether rampant consumerism is such a good thing and its impact on the world's natural resources, etc. But as an argument, we'll say that the more money that's going around here, the better it is for businesses, the better it is for households. Okay. But that's a very simple model of the economy, and it doesn't take into account all of the economic agents. So we've also got banks as an economic agent within the economy. Okay, and households give money to banks, and that's called savings. That money is taken out of the economy. Now then, banks can put money back into the economy. For example, when businesses borrow money to buy a new factory, that's called investment. So again, all of these arrows represent flows of money, either leaving or entering the economy. Another economic agent is the government, of course. So the government takes money out of the economy in the form of taxation, and it puts it back in by spending on schools, hospitals, etc. Finally, we've got money that goes abroad. Okay, we've got money that goes abroad because we buy imports. Now, the imports come into the economy. This arrow you'll notice is going out because it represents money. When we buy an import, the good comes in, but the money goes out. But equally, we do get money back in from abroad when people buy exports. When we sell goods and services overseas, money comes back into the economy. We call the withdrawals from the economy, the money leaving the economy is withdrawals, and the money coming into the economy is called injections. And again, this is known as the circular flow of income. All right, it's this very simple model of how the economy works, but on a very basic level, the more money that we've got flying around here, the wealthier people are going to be, the more confident businesses are going to be in production, and production and consumption will increase, and in theory living standards will rise. Okay, so the government has got 4 objectives in relation to the economy. Okay, these are all things that have an impact on business. Okay, so the first objective the government has is economic growth. It's an increase in the output or productive capacity of economy measured by GDP. Right, we're going to have a look at GDP in a bit more depth, so I'll go into exactly what we mean. But the key thing is it's an increase in output. The government wants more goods and services to be produced. And what's the policy objective? Well, they want high and sustainable economic growth. Okay, what you mean by high would depend on what country you're in. The Chinese economy grew in double digits for many years. It's coming down to around 6 or 7% a year, much higher than the UK. UK government would be happy with 2 to 3% growth a year. Probably 3% growth a year would be considered high enough. The government also wants to minimise unemployment. Unemployment could be defined as the number of people who are willing and able to work but can't find a job, and the policy objective is full employment. Price stability is about prices remaining relatively constant. Okay, inflation is what we call price rises. Okay, so if you think back to when you were younger, maybe chocolate bars were a bit cheaper when you were younger. The prices generally rise over time, and that's called inflation. And the government doesn't want 0% inflation, it doesn't want complete price stability. What we want is low and stable inflation of around 2%, 2% plus or minus 1%. So 2.7% is okay, 1.3% is okay, but we want prices to be rising slowly but steadily. The reason being that means firms can afford to put up their prices slightly, increase wages to workers, pay their shareholders a bit more, create some money through investment. Prices don't rise so quickly that it gets out of control and consumers can't afford goods and services anymore. The final objective that the government has is to have a balance on the balance of payments, where the money leaving the economy for imports is balanced out by the amount of money coming in from exports. Okay, so the balance of payments measures the value of exports minus the value of imports from one country to another, and they're the main 4 government objectives in relation to the economy. Okay, so quite a lot of information on this in this little presentation. One more slide here. The government's got those 4 objectives, those 4 things it wants to achieve, and the government has got 3 policy ways of achieving those objectives. Okay, the first one is called monetary policy, which involves using the supply of money, putting more money into the economy, taking money out of the economy in an attempt to influence growth, jobs, price rises. The government can also use fiscal policy, which is about government spending and taxation to influence economic activity. For example, in a recession, governments might cut taxes, increase their spending in order to stimulate the economy. Those two things you need to know about, they're on the specification. Supply side policies are not on the specification, but these are policies that basically make it easier for businesses to produce. So if you think back to, I made a video on infrastructure building. Infrastructure is about the roads, the railways, the pipelines. They're supply side policies because they, building infrastructure makes it easier for businesses to supply goods and services, and that can be a source of economic growth. So that's an overview of the economic environment. There was a lot of information in that. It might be worth just having a little read around some of those terms, or if you've got any questions, feel free to ask me. But we'll get into next the things that are specifically on the specification.